Morning, everybody. Good to see everyone here. Beautiful day. Finally, sunshine has arrived. Well, it's arrived in Suffolk anyway, which is a very nice, gorgeous day. Nice day to have a little roam around the gardens. So yeah, thank you all for making it. And we're streaming this event, so everyone who's coming in on stream, welcome. Good to have you here. I've got a little bit to run through as an intro before I hand over to the guys and girls to tell you all the good stuff. And the bit I'm going to run through is to do with some of the portfolios that we run. As you know, we run the Gaia range of portfolios, which is our sustainable range. And we also run a range called Ruby, which is, for want of a better definition, core, whole of market. And what we've been doing, we had a big review over the last few months. The guys were looking at the portfolios, the Ruby range, because in that range, we have 5 risk categories, and we have 2 portfolios in each of those risk categories, and I have since 2010, 2011. And we've been looking at the performance differential between the 2 portfolios that have been sitting in each category. So we've been now got a long history. We've been able to look back and see what's been going on. And truth be told, there's practically no difference in performance between those 2 portfolios. I mean, minuscule, like 0.2%, minuscule. So we took the decision that we're going to rationalize, and we're going to reduce down to having 1 portfolio in each risk category. So for instance, if you're moderate risk, we've had Ruby Growth 6 and Ruby Growth 7. We're rationalizing down to Ruby Growth 6. No difference fundamentally in risk structure, cost charges, and so forth. And we are also renaming the range of portfolios. So they're no longer going to be called Ruby. And when the slides come up, you'll see core portfolios, C-O-R-E. So we'll have core moderate, core cautious, core conservative, and so forth. If I haven't caught up with you to explain this in detail, if we haven't had a meeting, then I will be. As we catch up on review meetings, I'll be running through with you specifically in terms of what, if anything, we need to be doing. So don't worry about it. It's not a big deal. It's more of a tidy up after 10 years, a little bit of a spring clean. And that's it. So without further ado, I shall hand over to Andy.
Thank you, Brendan. As always, we will start with the performance, and I'm pleased to say that when we were here last time in November, markets were pretty challenging. The previous 6 months had been a period of market falls across all asset classes, to be honest. The last 6 months have been better. We have not necessarily turned the corner entirely, but things have certainly improved. So this is the performance to the end of the first quarter of this year, so the fourth quarter of last year and the first quarter of this. And as usual, you have the Investment Association average performances as well. They are all nicely positive. The core range, as Brendan explained, is now called, I've kept it red just so it's easy, so you can remember that was Ruby, are slightly ahead of the Gaia range, but there's not a massive difference in it. It's been a decent time for assets generally. So it's nice to see that we're back onto more familiar territory. If we look at the longer term, the 3-month numbers, because we have 3-year numbers, beg your pardon, we do have 3-year figures for Gaia as well now. Again, you'll see quite decent positive performance over that period, which, considering what we've been through, the pandemic and everything else, is quite pleasing. It's been a fairly unusual 3 years, to say the least. Certainly not the norm, but the numbers have still come through very nicely. There isn't a massive difference, to be honest, between the core portfolios and the Gaia portfolios. Gaia slightly ahead in some risk levels and slightly behind in the others, but there isn't much. But they're generally quite nicely ahead of their sector averages, which is the really important thing. We don't run money always to try and beat our peers, but it is a good sense check for us to compare what we're doing to the average. And clearly, if we're ahead of the average, then we're adding some value, which basically makes your situation a bit more secure than it would otherwise be, which is ultimately the entire goal. If we look at 5 years, The Gaia bars drop away. We don't yet have a 5-year track record on Gaia because it launched in 2019. But again, you can see the core portfolios nicely positive. And I was asked by a client at one of the presentations last time to put the long-term numbers on. For what they're worth, these are the 10-year numbers, which reinforce two things, really. In spite of everything that's happened, the last 10 years has been a very good time to be invested. Not all of you will have been invested in that period, but some of you have been invested with us that whole period. So it's been a nice time to be invested. The numbers are all nicely positive. I mean, you've more than doubled your money at the upper end. But really pleasing for us is that all of the portfolios are well ahead of their sector averages, which is ultimately over the longer term what we would hope to achieve. Over the short term doesn't always work out that way. We can position differently from others in the market, but it's nice to see over the longer term that compounding effect coming through and adding to your financial security. So it's been a bit of a better period. I'm going to let Nick put some meat on the bones of what's gone on in the last 6 months.
Okay, I'll do what I do normally. I'll take you over the performance of the broad asset classes, look at what's driven markets over the last 6 months, and then move on to an outlook before handing back. Okay, so over the last 6 months, Japanese equities in sterling terms have risen almost 9%, so a very different experience to when we were here last. And then the figure underneath in brackets says over 1 year they're up about almost 3%. UK equities have risen over 12% over the last 6 months, also up about 3% over 1 year. UK gilts, UK bonds issued by the government, have risen 4% over this year, very much in the eye of the storm last year. However, over 1 year, they're still down 16%, but the last 6 months has been much better. UK index-linked gilts, so government bonds with the linkage to inflation, very much in the eye of the storm of the Liz Truss budget last year. Over 6 months, still down by 2%, down almost a third still over 1 year. UK corporate bonds, so bonds issued by companies, up over almost 10% over the last 6 months, so a vastly improved situation to when we were here last, but still down over 10% over 1 year. European equities up a massive 22% over the last 6 months and up 10% over 1 year. I think European equities were very much in the eye of the storm last year, with natural gas prices going very high and people pricing in a recession in Europe. As natural gas prices have come down, that's very much helped European equity markets have performed particularly well over this period. US equities, a market that often has outperformed when we've presented at these, actually over this period has been a bit more of a laggard, rising 4.5% over 6 months and down sort of about 1.7% over 1 year, although some of this is currency, as sterling has strengthened somewhat against the dollar in recent months. Chinese equities, offshore, what I'm listing here, so Chinese equities listed in Hong Kong. They're up 7.5% over 6 months, very much benefiting from the sort of reopening post-COVID in China, up 2% year to date. Whilst emerging markets have still struggled somewhat, but nonetheless delivered a positive return of 3% over 6 months, down 4.5% over 1 year. So what's driven what's gone on over the last 6 months? Well, it's very much the same story as when we were here last. The main concern has still very much been about inflation and central banks ratcheting up interest rates to combat inflation. So when we last presented, we were here in November, interest rates would have been around this sort of level. And as you can see, both in the US, the UK and the Eurozone and elsewhere, rates have continued to rise. And actually, since I've done this chart, they've gone even higher since then as well. So obviously, it's just a very crude way, really, for central banks to take steam out of economies and basically reduce demand and try and get prices down that way. How do these rate rises compare, what we've just experienced over the last sort of 6 months or a bit longer, how does that compare to other cycles we've seen? This chart here shows previous hiking cycles in the US, previous interest rate cycles in the US, just to give you an indication of the magnitude of the current one we've just experienced. It shows you the change in the interest rates rather than the absolute levels of interest rates. This orange line here is the interest rate cycle that began in 1976, a very long and drawn out and aggressive interest rate cycle. What actually happened towards the end of the 1970s is that the Fed thought it had beaten inflation and it cut rates sharply, only for inflation to come back quickly. And in response, this line at the front here, the Fed ended up putting up rates really aggressively again to come down on inflation again. The blue line here is the interest rate rising cycle of 1973. But actually, the red line here is our current interest rate cycle. So what we can see is actually, versus history, this is actually one of the most aggressive interest rates tightening cycles on record. So you can see what, when you start feeling it on sort of the mortgage and things like that, this is pretty much as aggressive as we've ever seen in history. But despite this, inflation is still proving to be stickier than what central banks would have hoped. These lines here are showing the consumer price index in the Eurozone, the UK and the US. So as we well know, inflation rocketed up. In the Eurozone and the UK, inflation went above 10%, a little bit less in the US, but still over 9%. As we can see, that inflation has begun to come down, much more so in the Eurozone and the UK and the US. Unfortunately for us, the UK is still struggling with particularly high inflation. So it's beginning to come down. However, this dotted purple line at the bottom is the central bank targets for inflation. So despite it coming down, you can still see that we're way, way above where they would like it to be. And that's why we've seen this continuation of rate rises in recent months. And we know from, when we go shopping, whether it be food, sugar, tea, gas, clothes, holidays, anything to do with pets, everything has got a lot more expensive. Despite all of this, the jobs market actually remains quite tight. You would have thought that with interest rates going up, our mortgages costs going up, everything we buy costing more, that actually jobs would start to be lost. But that really hasn't been seen so far. This is showing the unemployment rates in the UK, the Eurozone and the US. As we can see from the right-hand side of this chart, actually versus history, it's very much at the low end of where we've been. Although this is arguably a backward-looking indicator, it's almost like the Federal Reserve looking in the rearview mirror to drive, we know that central banks are looking at this for an indication of how much further they've got to raise rates. So although we haven't seen stress maybe in the jobs market, we have started to see stress elsewhere from these interest rate rises. And perhaps the best known example of this in recent months has been the collapse of a regional bank in the US called Silicon Valley Bank that collapsed early, a direct consequence of interest rates going up. In turn, the contagion brought down Signature Bank, and the contagion spread across the Atlantic, and it brought down Credit Suisse as well. A relatively well-capitalised bank at the time, Credit Suisse, but a very badly managed one. I won't go into further detail on this, as Andy is going to do a piece on the banks. So all that, despite that doom and gloom, there are some bright spots. It's not all bad. European natural gas prices have tumbled. They've absolutely collapsed from where we were. After the Russian invasion of Ukraine, European natural gas prices peaked at over 300 euros a megawatt hour in Europe, as we all know. And it was at this point that suddenly governments around Europe started capping energy costs for consumers and companies. But actually in recent months, we've seen it come all the way down, and now it's roughly at around 36 euros a megawatt hour, so an absolute collapse of where we were up there. It's still at elevated levels where we were before, but nonetheless it's come down meaningfully. It's not saying it's not going to go up again as we approach wintertime. Goldman Sachs are estimating that it potentially could treble going into winter, but even if it trebled, it would take us back more around 120 euros a megawatt hour, nowhere near the levels that we saw before. And that's only a guess by Goldman Sachs. It's not a forecast or anything like that. China reopening. China was very much behind reopening from COVID versus us, as they were much slower with their rollout of the COVID vaccines. And in addition, their COVID vaccine was not as effective as ours in the West. So they only reopened at the beginning of this year. That actually got brought forward what we thought they were going to do in the West. We thought they were going to reopen more around Easter time, but there was unrest in China, and that brought forward that reopening time. Now, in China, they've not had furlough schemes like we've had in the West. Consumers have not received money from the government. However, you have had a lockdown for the best part of 3 years, a lockdown that's been far more aggressive than ours. So they physically have not been able to spend money like we have. So their savings have risen. Now you've got this reopening, they can actually go out there and start spending this money in restaurants and shops again. The recovery is going to be very much a consumer-led recovery. It's not going to be a recovery like perhaps we had after the financial crisis. There's not been monetary stimulus to help them along with that. So therefore, if the West does suffer a slowdown, it's unlikely to come to the rescue of the West. However, it is helping the Chinese economy, and it will help economies near them in Asia as well. Despite all the tough talk from central banks, be it the Federal Reserve, the Bank of England, or the European Central Bank, actually we have seen a moderation in the amount that rates have been going up. At the beginning of the cycle, the US Federal Reserve were raising rates by almost 0.75%. But actually that went down to 0.5%, and recent increases have been 0.25%. And actually we think we're getting closer towards the top. And it's been a similar story in both the UK and Europe as well. As markets believe that we're getting to the peak of rates, the rate cycle in the US, we've also seen a moderation in the dollar. Why does that matter? Well, when the dollar strengthens, that sucks liquidity out of financial markets, and that puts downward pressure on prices. And therefore, when the dollar weakens, you get the absolute opposite. Liquidity comes into financial markets, and that helps prices rise. So this chart here shows the exchange rate of the euro and sterling against the dollar, and there's been a meaningful recovery. It's not saying the dollar's cheap at this level, it's not, it's still expensive versus history, but there has been a meaningful move from the lows of October of last year. And equity valuations have fallen, so the prices that investors pay in stock markets are cheaper today than what they were when we last met. So that can only be good for end investors. This chart here shows what we call the price to earnings ratio of equities. And what we mean by that is how many dollars do you have to pay for every $1 of company earnings in the US? What the chart shows is the line. As the line goes up, stock markets are becoming expensive. And as the line goes down, stock markets are becoming cheap. What we can see over the last 6 months, the exuberance that we saw before has come off. Those very expensive prices in US stock markets have come down to more now. Okay, they're still above a longer term average, but they're much cheaper than where they were before. And it's a similar story for other stock markets. This is European equities. You can see the exuberance here has also come down. They actually fell beneath the long-term average and began to price in some sort of recession there. have recovered in recent months. Perhaps the standout one are actually UK equities. We've obviously had our own issues. There's a lot of bad sentiment towards the UK around Brexit, and we obviously had the Liz Truss government and things like that. That didn't help either. And we saw here that actually valuations in UK equities very much fell into recession territory, have recovered somewhat, but are still very cheap versus their longer term average. Therefore, as an investor, if you've got a longer term horizon, today looks a pretty decent entry point in the UK, even perhaps with some unknown things potentially, potential recession in the future. Emerging markets, exactly the same story. Actually emerging markets today are trading just underneath their long-term average, so not a bad entry point if you've got a long-term view. And it's not just equity markets which look cheaper as well. Bonds, which were so expensive over the last decade, and obviously were at the eye of the storm very much last year, look a lot more attractive today. This increase in bond yields, which is essentially the interest rate you receive by owning a bond, have risen sharply. Unfortunately, as the bond yield goes down, that does mean you're suffering a capital loss. But for an investor coming into these bonds today, the interest rate you receive on these is a lot more attractive than what it was. Not only are bonds offering a rate often in excess of what you might get in cash, but government bonds, which are trading around cash levels, are a defensive asset. And if equity markets fall, some of those defensive characteristics have returned to bond markets that we've not seen for many years. However, and of course there's always a however, it's never that straightforward just to say, oh look, things are cheap, put your money in, off we go. As we've said many times in these meetings, monetary policy, i.e. the raising of interest rates, acts with a lag. And that lag is anywhere between 12 months and 24 months. And central banks don't really know. So as I said, as central banks put up interest rates, they're really looking in the rear view mirror as they do this. And obviously the danger is that they put up interest rates too much already, and that causes some sort of a recession. However, I think the word recession conjures up fear in investors. We think 2008, we think COVID, but actually recessions don't have to be like that. Recessions can actually be shallow, don't always have to be as dramatic as we've become more used to in recent years. So what's the outlook? Well, whilst inflation is still above target, we may still have some further rate rises. However, they are moderating, and we do think we're getting close towards the peak. We're very much sort of walking up this hill, but we can see the end in sight. Central banks know this acts with a lag, and so they're not just going to carry on putting up rates forever. They know they will be patient. We may still see one or two in the UK and in Europe and perhaps in the US, but we're very much towards the top end of them now. We expect inflation to continue to roll over. As those excess savings that were got during the COVID years get spent and interest rates have an impact on our pocket, that means that demand will start coming down and prices will naturally start to moderate. I think the Chinese economic recovery is still set to continue, but as I said earlier, it's going to very much be consumer-led. So it's not going to be this big bang recovery like perhaps we saw as we reopened. It's going to be much more steady. But nonetheless, it will still help China, and it will still help those economies around China as well. As I mentioned earlier, equity valuations are lower, and there's also widespread investor caution. Normally, if you take low equity valuations and widespread investor caution together, that's normally a strong buying signal. You actually want to buy when other people are fearful, not when the herd are buying. However, as we said earlier, because we know monetary policy acts with a lag, that actually makes us a little bit cautious on equities. We maintain an overweight to China and Asia in equity, benefiting from the recovery trade in China. But we've also increased our exposure to government bonds, where you get higher yields today, so they make much more sense on that basis anyway, and the defensive characteristics of government bonds will be much more meaningful than we've seen for many years. I will now hand over to Andy.
Thank you, Nick. I thought I would, as Nick mentioned earlier, I'm going to touch on what's happened in US banks recently. Because if you've seen some headlines about bank failures and so on, I'm sure some of you have thought, oh, hang on a minute, are we here again? Are we back in the global financial crisis? And let me take you back to some dark days, just as a reminder. I think we all remember this very well. We're not used to bank failures, really, in Europe and the UK. It doesn't really happen very often, which is a good thing, obviously. But when this happened, it was a bit of a shock. I don't think many people remembered many. And at the time, there was a lot of conversations about why did Northern Rock get into trouble. They'd done some very different types of mortgages, and the way they financed themselves was very different. They'd lent way more money than they had on deposit, and so on and so forth. So a lot of it was written off as, Northern Rock, it's just not been very well run. But actually, Northern Rock turned out to be the canary in the coal mine, because this was early in 2008. By the second half of the year, it was dominoes time, as bank after bank got into trouble because something much more serious was happening in the global financial system. Bradford and Bingley, household names, Halifax and Lloyds merged and then needed government bailout. Anyone want to offer me a name for this gentleman? Fred the Shred was his nickname for his habit of cutting jobs when he bought a bank. Sir Fred Goodwin, as he was at the time this photograph was taken, was very soon thereafter no longer Sir anything. Obviously, if you blow up the nation's biggest bank, you lose your knighthood, appears to be the deal. So there was a whole series of problems in the UK banking system, as all these one by one fell over. There was a not dissimilar pattern in the US. Early in the year, a bank called Bear Stearns got into trouble. And again, similar sort of conversations. Why have they got in trouble? Oh, they've lent mortgage loans really badly to people who clearly can't pay. So they're a bit different. Nobody else has done this. They've just run their bank badly, so don't worry, was kind of the story. Now, this lending got its own name. Okay, it got nicknamed as Ninja loans. And Ninja stood for no income, no job also. They were lending to anybody. Whether you had an income, whether you had employment or anything else, it didn't matter. They would lend you money. Go buy a house. Off you go. And you think, why on earth were they doing this? And of course, then it was discovered they were then selling those mortgages to third parties. So if they went broke, they didn't care. They'd sold it on to someone else. It was someone else's problem. So as a result, their risk controls were basically non-existent. Just sell loads of mortgages and we'll flog them onto someone else. And of course, eventually it did come back and bite them on the posterior. They were the US canary in the coal mine, because before long, and there's a name I'm sure you remember, Lehman Brothers. September the 15th, it's even got the date very kindly on the front of their building for us to remind us when it was. Lehman Brothers went bust. And there was lots of coverage when that happened. But actually, Lehman's wasn't really as big as some others. Washington Mutual was the really big one, a bank I suspect few people, if any, in this room have ever heard of. A regional US bank, but a big one. That one also got into trouble, and that's again when the US equivalent of the domino started going down, and we had, which we all remember, the global financial crisis. It got renamed. It was called the credit crunch at the time, and then somebody decided it needed a new name afterwards, so it got called the global financial crisis. Okay, so that's history. So what exactly is going on now? Nick mentions Silicon Valley Bank. Okay, again, a medium-sized regional US bank, did have a UK arm that HSBC acquired for £1 a few months ago to bail it out, but not really known here. And that went on the 10th of March, followed 2 days later by Signature Bank, which was the third largest bank failure in the US. So this is not insignificant. And more recently, about 3 weeks ago, First Republic Bank. So why is this happening? Are we back to the same global financial crisis problems we had before, or is this a bit different? Well, I think this is a really interesting slide, and I hope you can see this. There's two bits of data on here. The blue bars are the number of US bank failures every year this century. So 2001 forward, and you can see 50, 100, 150 down the side. So you see that it's actually not unusual for the US to lose the odd bank. Okay? They have more bank failures than we seem to over in Europe. But, you know, one, maybe that, I don't know, 4 or 5, 1, 2, none, none, 1. And then, of course, here is the global financial crisis. Here is this huge swathe of banks, hundreds literally going bust. The pink line is a representation of how many assets these banks had, how much money and investments and so on they had in them, because this is important. Okay? So if you look at 2008, and I've just mentioned Washington Mutual, Lehman's, and a few others, it wasn't that a large number of banks went bust, but they were quite big, had a lot of money in them. The following year, 2009, a lot more banks went bust, and the year 2010, even more, but they had a lot less money in them. In fact, that was the problem. They didn't have any money, which is why they got in trouble. But I show you this to make the point about what's happened in 2023. That tiny little line is the 3 banks that we've just talked about. Only 3. It's a very little blue line. But they had a lot of money in them. Now, regulators play around with the amount of money that banks are required to keep at any given time. Increase it, decrease it, whatever. And since the global financial crisis, they've generally required banks to keep more money in reserve, readily available to be paid out. Okay? And yet, in spite of that, these 3 very sizable banks still went bust. So is this a good thing? Or is the fact that banks with that much money went bust, is that something we should be worried about? Because they were sizable. Well, here's an indication of what the issue is. This is a profile of the money that was in, the deposits that was in Signature Bank, one of those banks I've just mentioned, the largest of the 3. Now, in the US, if you have up to $250,000 in the bank and your bank fails, the government effectively bails you out. They give you your money back. So if you've got a couple of $100,000 in the bank, it's not a major stress point for you. It's not what you want, because probably then your online banking doesn't work and the cash points maybe don't work and you'll have a disturbance for a while, but you will get your money back. But if you've got 10 million in the bank, you're insured for £250,000. Now, the problem with the 3 banks I've mentioned, they all went after very niche parts of the banking market. Now, we talk to you regularly about investing and the importance of diversification, investing across lots of different types of assets in different geographies. So if one particular asset class or part of the world struggles, you don't have all your eggs in one basket. The same can apply to business. But these bank managements ignored that, and they targeted one particular part. Silicon Valley Bank they were taking deposits from hedge funds, crypto exchanges, big corporates, putting lots and lots of money in. Signature Bank was a little bit similar. First Reserve went after super rich individuals, provided them with concierge services around their banking and so on. But the result was, when you looked at the profile of depositors, most of them had uninsured money because they put 10 million, 20 million, 30 million. So they're very, very mindful of the state of the bank. And if they have any wind that bank's in trouble, they're pulling their money in a way that Joe Bloggs in the high street wouldn't worry about. Yeah? We still saw queues outside Northern Rock because nobody really wants their bank to go bust. But actually, most of those people would be made whole by the UK government. The problem with these 3 banks, they all had big, big depositors who weren't going to be made whole and were therefore nervous. Now, the first one that I mentioned, Silicon Valley Bank, there was a certain irony in that. One of their clients was a big hedge fund that had tens of millions of cash, and they got wind that Silicon Valley Bank might not be as well structured and as secure as it should be. So they pulled their tens of millions, and that was okay. But then they told all their hedge fund investors what they'd done and suggested they might want to do the same thing as well. So all these other big rich people went into Silicon Valley Bank and pulled their money out. And that was the end of SVB. Okay, because if everybody wants their money back at the same time, a bank will fail. Why though? Why does it happen that way? Here's the fundamental issue. And everybody in this room is involved in this system, whether you know it or not. Let's go back to original banks, the concept. If you were a wealthy merchant a couple of thousand years ago and you had jewels, some gold, maybe some coins if coinage was around at the time, you'd be worried that if you kept that in your house, that somebody could break into your house and steal it. So you would want somewhere to store that was safe. Often they take it to the temple, and the temple would provide security and store it for them. Effectively, an old-fashioned safe deposit box, and you pay a fee for your safe deposit box, and you put your important documents in it, and your family jewels, whatever, and you lock it away. Early banking was just that, a safe place to leave your valuables that would potentially charge you a fee for doing so, put guards in place, and make sure it didn't get stolen. But then at some point, someone said, we've got all this money lying around here. We could lend this to people and charge them interest, and we could make some money. And that's when we changed to this system, fractional reserve. The money isn't all there. The merchant in the old days could go into the temple and say, can I have my gold and jewels, please? And they went, there you go, there are your gold and jewels. Thank you very much, off you go. If we walk into the bank now, they have some cash. And most of us won't break the bank because we're not wealthy enough to break the bank. But if enough people go at once, the money isn't there. It's been lent for mortgages, for car loans. It's been invested. It's tied up in other things. Now, when I was a kid, I was taught the UK banking system worked on an 8% number. If 8% of people asked for their money back in one day, the whole system failed because 92% of the money was somewhere else. And this is called fractional reserve banking. Now, the issue with this is, it doesn't matter what reserves the regulator says you need to keep, whether they say you've got to keep 8% or 10% or 15 or 20. Silicon Valley Bank lost 30% of its deposits in one day. Signature had calls on 90% of its deposits over a 3-day period. It doesn't matter what the regulators say about keeping reserves. There's not a bank on the planet survives that if it's working this system. And this is the global banking system. So we have to accept, if we'd like to borrow to buy a house with a mortgage, we're in this system, and then there will be bank failures because enough people panic and all ask for the money at once, the bank will fail. Now, US banking regulation is perhaps looser, and the way that management are allowed to run their banks is perhaps freer. Donald Trump actually deregulated medium and small-sized US banks in his first term. Let's hope it's his only term, but maybe it's his first term. He thinks it's his first term. We'll see. But in fairness to him, if 90% of the money is asked for in 3 days, there's no regulation in the world stops that bank from failing. It is that simple. So effectively, we should get used to it. There will be bank failures. It doesn't necessarily mean there is a systemic problem. It's the nature of the system. So it's only 3. We see no reason at the moment to think this is a more systemic problem. But here's my however slide. Nick got a however slide. I get a however slide. Okay? We didn't know this when Northern Rock and Bear Stearns went bust. And then, as we peeled the onion, we discovered, oh, so Bear Stearns have sold their mortgages to someone else. That's not a big problem. Who's bought them? Low-risk pension funds. Oh, and they've geared them up, and they borrowed loads of money, and there's loads of it. And it was like, oh, hang on a minute. What have you done, Mr. Banker? Have you done loads of this stuff? Yeah, quite a lot, actually. And is it all really bad quality? And does everybody own it? Yeah, we sold it to everybody. And then the problems came out. So I can't unequivocally say to you that someone in the US banking system hasn't done something really clever that isn't, that will turn out to be a problem, because I'm not in the US banking system. We didn't know last time quite what had gone on until, as I say, we peeled the onion and the tears came. But at the moment, we see no reason to think that what is happening is anything other than just what can happen in a fractional reserve banking system. Okay? So we're not panicked about it. We can't guarantee anything, but it appears to be just one of those things. There will be potentially more that will go. There are some other mid-sized American banks who are wobbling because people are now panicking about the whole system. And what's happening is US depositors are going, oh, I'll take it out of there. I'm putting it in the big bank in JP Morgan. JP Morgan have had billions of dollars flow in of people taking it out their local bank and putting it in the big national because they've seen these 3 go. And that in turn can take a few more banks down, but it doesn't look like a systemic crisis at this point. So a bit of peace of mind, hopefully, in case you were looking at going, oh no, here we go again. Okay. I'm now going to pass over to Phoebe, who's going to tell you what's been going on in the world of sustainability. Thank you.
So lovely to see. Well, the audio is great today. I've got the Eurovision and the Coronation team here, in case you didn't know, so definitely get the gossip from them afterwards. Anyway, sounds great, looks great. Lovely to see everyone today. For those of you who don't know me, I run the Sustainable Investment team at LGT, and we've partnered with Phoenix almost 5 years ago now to launch the Sustainable Gaia range of portfolios. And when we launched the portfolios, I think the idea behind them was for clients such as yourselves to align your values, your non-financial values, with your investment portfolios, to invest in companies that were aspiring for a cleaner future, a fairer future, a future that would set the planet onto a different trajectory than the one that we've been on over the last 50 years. But what's really interesting is that this values-based discussion has really broadened. And now for companies all over the world, it's not just a sacrifice that they're making to make their products cleaner or safer. It's actually really an inherent business-based decision, a financial-based decision. And I wanted to demonstrate that by showing you the outcome of a survey done by the World Economic Forum. So this survey goes out to business leaders, CEOs, C-suites, and asks those business leaders to prioritize the risks that they see to their company over 2 years and over 10 years. And this is in order of, of severity, of impact. So risk number one, I don't think you can see it very clearly here, is the cost of living crisis. This is a global survey, and most business CEOs, chairmen are saying cost of living crisis is the biggest risk factor to our company over 2 years. Risk number two is natural disaster and extreme weather events. Risk number three, geo-economic confrontation. Arguably, you could say linked very much to environmental issues. And risk number four, failure to mitigate climate change. So you can clearly see quite a broad spread of different risk factors that are the most important thing for these people running companies. If you fast forward over 10 years, the top four risks you can see in green: one, failure to mitigate climate change; two, failure of climate change adaptation; three, natural disasters and extreme weather; four, biodiversity loss and ecosystem collapse related to climate change. So this is no longer something that people are thinking about because they're trying to do the right thing. This is absolutely a financial risk factor at the heart and the priority list of businesses across the world. Now let's look at the cost of climate change. And I've got here a chart showing weather events, extreme weather events, in the US. Now, I'm not going to say that all extreme weather events, and this is last year, were caused by anthropogenic climate change, so that's man-made climate change, but the number of extreme weather events is on the rise. There were 18 separate weather events in the US last year that each cost more than $1 billion US. The total sum of weather events in last year, in 2022 in the US, was over $165 billion US. So you can see droughts, you can see flooding, you can see hurricanes, you can see tornadoes, and they are concentrated in some states, but it's still a pretty broad spread. So if you're a business operating, it could be your consumers or your customers are in one of these regions, your supply chain, the manufacturing base, the offices, there's clear disruption going on as a result of increased levels of weather events. So if you're a business, you're really having to think about how to mitigate this. You have to have an action plan for now and in the future to be able to diversify your manufacturing or diversify your supply chain away from areas that aren't being hit by extreme weather. The unfortunate thing is this pattern is being seen all over the world. It's not just the US. You're seeing the same in many parts of Asia. In Europe, last summer, you're probably very aware there was an extreme drought really, really impacting our region. So for a business that's trying to diversify geographically, where does it make what it's going to make? There's actually very fewer and fewer places that are providing the type of climate and the consistency of climate that we once had. Things are changing, and if we look at things like the percentage of energy, this is Europe, coming from individual energy supplies, you can see that there has been a considerable shift over the last 10 years in the use of coal. So the use of coal has gone down by 25% as a proportion of the overall energy mix, down to 14%, and the balance has been made up, pleasingly, by things like solar and things like wind. But these numbers do seem quite small when you're talking about an entire decade. You can bring it to life a little bit more clearly by looking at individual countries. So this map shows the primary energy supply of different individual countries. So Germany, unsurprisingly, and we all know this very, very well at this stage, dominated by coal. 34% of Germany's energy production is made up of coal. Perhaps a little bit more surprising are countries like Portugal, Iceland, Sweden, Norway, Austria, and Croatia, where the dominant energy source is hydropower. Potentially surprisingly, Spain, the dominant energy source is wind, and that's as a result of a lot of investment by the Spanish government in wind power. But if we go one step below the surface, in the UK, which is still dominated by gas, an increasing proportion, and on best days, sort of 35% of energy is produced by offshore wind. So there's been a lot of investment in the UK in offshore wind and onshore wind, but specifically offshore wind. And so we're on a tipping point, really, in the UK with regards to having our maximum energy source from renewable sources. The same is the case in Germany. They have 34% of their energy coming from coal today, but the second biggest energy source is wind, and that's at 25%. So a lot of change going on underneath the surface. But it's really important to think about the effectiveness of different energy sources. This is a chart that I find really interesting. Each individual dot shows 1 hour of last year and plots the energy generation along the bottom, so how much energy in megawatt hours was produced in that hour, and then also demonstrates how clean or not the energy is via the CO2 intensity. So high CO2 intensity, not particularly clean. Low CO2 intensity, very low levels of pollution. And each of the colours is different countries. So I spoke to you about Germany. This is the German splodge here. And because there's quite a big mix between coal, which will be high energy intensity in terms of the carbon emissions, but quite energy productive over here, and then you've got a mixture of wind, which will be down here, you've got a big spread. Potentially a bit more interesting is France in blue. So France is dominated by nuclear. Very controversially, nuclear is a really big topic at the moment in Europe because it's just been classified as a green investment, having not been before. So that means for investors in Europe adhering to the rules and regulations around sustainable investing, they can now include nuclear in some of those investment products. As a result of investing in nuclear, we all know nuclear has got very, very, very low carbon intensity when the energy is produced. Now, it's not perfect. You're still mining uranium. You've still got a lot of waste that's indisposable, so it's not a silver bullet, but clearly it's massively better than coal, oil, and gas when you're thinking just about the carbon intensity. But what you might find interesting is the amount of energy generation, the variability, because you think nuclear is pretty consistent. If you're turning on a nuclear reactor, if it's on, it's on. However, as a result of the droughts last summer, which I mentioned earlier, really catastrophic for places like France because entire rivers dried up. Nuclear reactors are located close to water sources, including rivers, and that water is used to cool down the nuclear reactors. But the water in the river entirely dried up, meaning these nuclear reactors had to be closed or were really, really inefficient. So this really demonstrates that whilst nuclear is good for the environment and helps us get towards net zero, caveats included, climate change itself is impacting its overall effectiveness, and you can see that here pretty clearly. The energy complex is changing. We had a discussion earlier about thinking about buying batteries for houses. Another big theme that we're seeing, and we've seen continue over recent months, is the demand for heat pumps. And this shows a massive increase. We've got 2003 here, 2022 here, massive increase in demand for heat pumps in Germany. The demand went up by 53% last year alone. So there's been some incentivization in the German economy to get people to buy heat pumps, but using natural heat, predominantly ground-based heat pumps, in order to further stimulate the amount of energy that you're able to produce as a consumer. We're also seeing a big shift coming back to nuclear in terms of countries' plans in investing in nuclear. It's gone from being a really taboo subject a few years ago to one that is very much on the agenda for countries across the world when they're thinking about hitting their net zero goals. The other outcome, of course, is it creates energy independence, which countries like China that are desperate to be able to fire whatever shots they want on the global stage, as soon as they get energy independence, they can be a lot more powerful and exert a lot more pressure because they're not reliant on different countries to get them energy to create economic growth and stability. So China has embarked on an enormous nuclear strategy and plan, and they're planning to build 150 new reactors over the next 15 years, which 440 billion, I mean, very few people, it's very hard to understand what that means. Well, it's more than the rest of the world has built in the last 35, the entire rest of the world. So really, really big plans from China in the nuclear space. One piece of good news that I've got to report to you as of the end of last year is that we had the biggest year ever with regards to investment in the energy transition. So it was the first over $1 trillion in a year investment year. Now, again, really, really hard to think about context. Best way of doing that is going back a decade and thinking just a decade ago, 250 was a really strong year with regards to investment. So the fact that we've got 5 times that in a single year, to me, really demonstrates the ramp up and understanding of how much investment is needed in a cleaner and more energy efficient economy. However, if you look at the amount, oh, sorry, I've lost the slide. However, if you imagine, just imagine the slide, the proportion of funding that's today versus what's required for the net zero commitments that have been made by countries across the world is completely dwarfed. So there's a huge amount more opportunity still ahead. I think what's interesting to look at is where is all this investment going? Is it invested in the right places for the right things? Well, this chart here shows it quite well. This chart here shows the proportion of global carbon emissions broken down into different end industries. So you have the built environment, cities, industries like cement, which are highly carbon emitting, and glass, food, agriculture and land use, so making food, energy, production of energy, and then mobility, which is cars and planes and trains, etc. What's potentially surprising is how distorted the allocation of funding is versus where the carbon emissions are being produced by. Potentially unsurprisingly, with the success of Tesla, 50% of all investment in the green transition goes into electric vehicles, electric scooters, electric mopeds, hydrogen trains, hydrogen planes, and hydrogen boats. So for tech investors or startup investors, it's a bit of a kind of following the crowd type of effect that's been going on, and a really significant proportion of that funding has gone into one area. Now, you could look at it in a negative area, thinking actually that allocation is incorrect. But the other way you could look at it is, what opportunity does this represent? In the wrong place here. What problem are we trying to solve? And this part here, food and agriculture, particularly here in the UK, is something that we really need to be resolving and thinking about how to make our food more sustainable by damaging the soil in much, much less and reducing the carbon miles connected to food that we produce. Yet there's only 12% of the funding in that sector. So I wanted to draw that to your attention and show you, in fact, some figures that the opportunity is absolutely there. So whilst climate change and particularly things like the electric vehicles, electric batteries get a lot of attention, a lot of airtime when we're thinking about the opportunity, there are significant opportunities in areas like plant-based food. So that's your Impossible Burgers, your Beyond Meat, these brands that have created lab-based alternatives to the meat that we consume on a weekly basis. Here in the UK, maybe the take-up and the opportunity isn't huge, but in places like Asia, the demand for lab-based alternatives to meat is enormous. The market today is represented by about 30 billion US dollars, but in just 7 years, it's likely to be represented by about 162 billion globally. Precision farming, I mentioned to you about soil health and soil quality. One of the major issues is that we're massively over-farming the soil and the fields that we have here today. I'm sure you've read about this or you've seen programs on this. And what it means is the soil that we've got here in the UK specifically only really has around a decade worth of life within it to be producing food at the same yield and crop yield that we have today. So precision farming looks to fix that issue. Precision farming using really careful technology to apply fertilizers and apply pesticides, but to the areas of the field that it's needed. You don't need to be liberally spreading all of these chemicals over the whole thing. Some parts of the field may not need it. And obviously you're also damaging the water systems with those same chemicals. So precision farming is a technique that more and more farmers are using. Interestingly, by using less fertilizers, which are created through really expensive chemicals that the cost of them is on the rise, like ammonia, the farmer themselves is saving money because they're using less of this really expensive chemical. And the yield, interestingly, of these crops often goes up. So it's a win-win. You're saving money, and you're potentially making more money through your yield going up of whatever you're growing. So the market of precision farming, potentially unsurprisingly, is going to go from about 7 billion to around 170 billion. I mean, echelons higher than where we are today. Vertical farming, I'll skip to there. I've spoken to you about vertical farms before. Those big containers, they look like a distribution centre. Inside that distribution centre, you have layers and layers of little boxes of vegetables like tomatoes, vegetables like salads. Those vegetables are grown in water, and you have that water recycled over and over and over. So there's really, really high efficiency of the water. I think there's less than 1% of waste of the water. Often these farms have solar panels all over the roof, so you have completely green energy. And because of the instability of the farming supply chains here in the UK, we've all seen empty shelves in recent months. More and more supermarkets are buying vertical farm businesses or setting up vertical farm businesses. So that next to your Waitrose distribution centre or Ocado distribution centre, you've got an Ocado vertical farm. And Ocado have done just that. They've started buying vertical farms all over the country. Because here in the UK, we face more problems than many other countries in having that regularity of supply. So unsurprisingly, the vertical farming market is likely to go up considerably over the next 7 years. So I think you're pretty hard pushed if you're thinking about an investor, and Nick and I are obviously looking at companies and looking at sectors on a daily basis. Where do we want to be allocating your money, our clients' money? What kind of industries are going to be generating these kinds of returns? It's really hard to find industries or subsectors that are seeing this sort of growth over the next 10 years and beyond. So coming back to my original point about sustainable investing being not just a values-based conversation, it's absolutely about risk management and not locating your manufacturing base, your supply chains in parts of the world that are being increasingly impacted by changes in weather. But it's also about tapping into opportunities and really identifying the companies and the sectors in the countries that we're maybe likely to see considerable growth over the next 10 years. So just summarising, what are the themes that we see for this year and beyond? Climate, absolutely crucial. I think it's important to think about the social transition, so this idea of a just transition. We could all move to a cleaner economy really quickly if we all put our minds to it, but we'd leave some people behind. We'd leave some countries behind, we'd leave some people behind, people that were in those dirty, more old-fashioned industries. And there's no point solving one problem, an environmental problem, and creating an entire social problem as a result of people being unemployed. Government spending, that's a massive change that we've seen in recent months. Last time I was here, I was talking to you about the US Inflation Reduction Act, which was a groundbreaking piece of legislation in the US that's passed $400 billion worth of spending over the next 7 years. I'll bring that to life in an individual company basis. Companies like VW, the car company, have estimated that by moving their electric vehicle manufacturing their factories to the US, they're going to be saving in the region of $11 billion in tax over the next 5 years. So lots of companies are looking at the incentives set out by Biden and passed by the House and the Senate last summer and thinking, I'm going to go over there, I'm just going to instantly save a whole lot of money on my tax bill. Now, clearly, Europe woke up to that really quickly and thought we're seeing a massive brain drain here, a resource drain, an investment drain. So really pleasingly, in the last couple of months, Europe have passed the same bill, exactly the same. It's called the Net Zero Industry Act. And what they can offer is companies like VW, if they're thinking about leaving, they say, stay here in Europe, we'll offer you the exact same benefit from a tax perspective. The problem is the UK are nowhere to be seen in any of this. We haven't created an equivalent bill. And as a result of that, there's already many business owners, and you may know some here in the audience, that are relocating their manufacturing and their investment to either Europe or to the US. So we're really hoping, just for the sake of the UK economy, that we see something at least the same, if not something more attractive. And the final point here is biodiversity and nature-based solutions. It's no point just investing in technology. We've got some of the most important natural capital solutions, trees, oceans, salt marshes, right here, particularly here in the UK. So making sure that they're protected and used in their natural way possible in order to mitigate some of these climate change issues as well. That's everything from me.
Thank you, Phoebe. If you'd like to stay up here, please.
Oh, yeah,
now
sure.
do Q&A, Nick. It's the usual disclaimer that says, please don't go and buy loads of cheap shares in US mid-sized banks, because they might go bust, okay? I did put that caveat on the end, all right? I'm just going to close this down so I'm not absolutely blinded while we do Q&A. Questions, please. If you could wait, if you do have one, for a moment to bring you the mic so that those on the stream can hear as well. For those that are on the stream, I know we've had some questions sent in already. If you want to send any further questions, please do fire them in, and we will have them read out and answer them for those of you that are coming in remotely. One at the back, please, Amona.
Thank you. Yes, I was thinking about China and the sort of ethical factor in investing in China, and I wondered what your views were on that, because I'm not very keen on supporting the Chinese economy, really.
Yeah, China and the ethical question, that will take us a few hours, because it's complicated. I'll have first stab, and then I don't know if anyone else wants to chime in. I can speak from the Gaia perspective, which is that we are very careful which companies in China that we've talked about this before, Phoebe and myself. So, you know, we steer away from completely companies that might be using slave labor in Xinjiang province and some of the obvious controversies. There was an article in Bloomberg a few years ago that talked about the dark side of solar power and 6 major US companies who are linked to Xinjiang, and we don't invest and never have invested in any of those. So we're very conscious of that. I think China is the second biggest economy in the world and wants to be the biggest economy in the world. And deciding to cut it out completely is a massive decision. And of course, you sort of wander into politics as well as ethics on this, and they are opinion to a degree. So to date, we've steered away from some of the real nasties, but we consider China to be investable because there's plenty of other pretty nasty governments around as well. But that becomes a very personal viewpoint about how you see them. So certainly on the core portfolios, we consider China very investable. Gaia as well, notwithstanding, we put a very careful sustainability screen on which bit of China. I don't know if you want to chime in.
I think the unfortunate fact of the matter is it's impossible to avoid the Chinese economy. If we think about anything that we consume on a daily basis, whether it's made in China or some element of it is sourced from China. And some of it we don't even see and would never be able to find out. So an example would be the fact that China processes between 70 and 80% of all aluminium, nickel, copper, and they've done that by stealth. So there's a program called the Belt and Road, by which they've bought up effectively a lot of the countries, particularly in Africa and in Asia, in order to claim the raw materials. Those raw materials and often metals go and get shipped to China and then processed in China. And then they've effectively kind of wrapped up that entire metal supply chain. So I don't want to sound defeatist about it, and we really go into detail with these companies, particularly ones based in China. We don't want to judge every company and every CEO by the human rights approach of the Chinese government. But having someone on the ground in China visiting companies is really, really important. And unfortunately, China has got its tentacles into sort of everything.
And actually, I think if I were going to follow through, I wouldn't buy anything made in China.
Yeah.
Of course I do.
Yeah. It's so hard not to, though. It's so
Well, I
hard.
mean, is it 85% of rare earth metals are under Chinese land or something? And
Yeah,
that's
they
the stuff that
process,
goes into all the phones, all the electronics and so on. So it is one of those things that, you know, we would live a very different life if we didn't buy anything that had any China connection, if, as Phoebe says, if you can even know. One here, please.
Thanks. Could you say a little more about the US economy? On your slide, Nick, it looked as though the US has recovered or grown more slowly during the last 12 months, whereas I'd always thought the US economy tended to recover from downturns faster. Is that because it had already recovered the previous year?
Yes.
Or are there other factors at play?
So the chart showed the performance of the stock market rather than the growth of the economy. That's very much a reflection that previously the US stock market had been one of the more expensive markets to buy into. So last year, as we saw falls in markets, the US was obviously hit quite hard by that. And also the US equities didn't come down to very cheap levels like perhaps we saw in Europe and the UK and China and places like that. So as investors have gone to put money back into the market, they've tended to focus on the cheaper areas, of which the US isn't one of them. So as I said, what the chart, one of my later charts was showing is that US valuations have become cheaper, but you still couldn't call them cheap versus history. They look a lot better value today. And as I said, if you've got a longer term view, it's probably not necessarily a bad entry, but you couldn't call them actually cheap.
Yeah, there's very little correlation, especially over the short term, between economic growth and stock market performance. It's one of those, because it depends how expensive it was at the start of the period and all those kind of things. I'm going to take one from Jen, if I may, that's come in on the stream.
I'm going to take you back to China for a minute, because the first question...
See, there's no getting away from it.
And it must be this is going to be difficult, actually, given what how you've just answered the first one. The first one says, to what extent is it possible to prepare for the consequences of any major geopolitical events, such as any Chinese attack on Taiwan?
It's a very good question that we discuss on an ongoing basis. What can you do?
I think you can look at it in terms of probabilities, and you can look at it from that perspective. But I think it'd be very foolish of us to think that we knew what was going to happen. And to that example, to try and judge whether China's actually going to invade Taiwan or not, for example, is a very difficult thing to judge. We all might have different opinions, but you only have to read in newspapers. People's opinions vary tremendously, and so we generally don't know. I think we're aware of geopolitical risks, and if you think that if the probability of any is higher, you can take actions against that. But in the main, it's very difficult to.
I think if you are thinking about the types of assets that would protect portfolios, they're the US government bonds that we know consistently protect the best out of all non-correlated assets, gold, the US dollar, and those are in all the portfolios. So it's not about positioning a portfolio, in my view, of the outcome of that, unless you really start to see evidence that it's going to happen or is more likely to happen. But having that comfort that there are things in your portfolio that will protect in that environment. Although in the event of that sort of event, we're probably all going to have our minds on other things. So it's obviously not something worth thinking about.
I just add one thing. I agree with all of that. I mean, you know, you could theoretically, and it comes back to that thing about you can't avoid it. You could say, well, I won't invest in China directly, but you're still linked to what's going on. And if there's a Chinese invasion of Taiwan, stock markets across the world will drop. So it doesn't really matter whether you've got Chinese equities or US equities. Everybody's going to freak, at least for a bit. Actually, stock markets tend to look through geopolitical events quite quickly, but you know, it's too interlinked to the global economy to really know anything other than what Phoebe said that would hold up.
Chinese equities might go up.
They might. Some good businesses on Taiwan. Jen, you got some more?
I do have some more. I'm going to sort of link the next two questions together if I can. So it says, given recent global supply chain disruptions, inflationary pressures, and I'll add in here the rising interest rate environment, what adjustments have we made? Have we been able to mitigate the impact of these challenges to protect investments?
Do you want to take that one, Nick?
So I think from our perspective in the portfolios, rather than sort of mitigating it, what you've seen as interest rates have gone up in relation to combat inflation, obviously linked to supply chain issues as well. You know, you've seen yields rise, i.e. prices fall on government bonds. So government bonds look a lot more attractive today. They are normally a defensive asset class, so we've increased our exposure to things like government bonds in relation to that. We think that although there could be further interest rate rises at this stage to combat inflation further, we nonetheless, as I said earlier, think we're nearer the peak, and therefore the risks of sort of material capital loss investing in government bonds we think is much less today than what it was before. And I think that's the main thing.
Just to put a little bit more detail on that, on the core range, we had a long-term underweight to bonds, to fixed interest generally, because it got very expensive. And as the yields improved and they got more attractive through this period, we started adding from October of last year and have added consistently through that period, buying more and more and more into that market to take advantage of some of the upside that comes with these difficult circumstances. You know, there's a fall in the bond market, so as always, every cloud has a silver lining. If something falls, it becomes cheaper, which gives us a more attractive entry point to then add, and we've added meaningfully on the core portfolios.
On the Gaia range, we started to increase cash weightings in portfolios at the start of last year. Now, nobody wants to be sitting in cash when you're looking for a return from your money, but given that equities and bonds fell by such a considerable amount, it was a great place to hide. And now we're looking to reintroduce that cash into the market when we see opportunities. Similar to what we've heard here, the fixed income, the bond market is really showing us some really attractive returns. I'll give you an example. One of the funds in the portfolio that you'll see is a fund run by a company called Vontobel. It invests in bonds that are going to mature, so you get your money back in between 1 and 1.5 years. And the yield, the interest, is almost 7%. So you're lending a good quality company money for just over a year, and that's the sort of yield that you're getting. And we haven't seen that in well over a decade, before 2008. So those kinds of opportunities are really here, and they're not going to be around for months and months and months. So locking that in portfolios is crucial. The other bit of the work that we had done pretty extensively before going into 2022 was looking at the levels of debt that companies have. Now, clearly, as interest rates go up, companies have a higher and higher cost of borrowing, as do consumers, but also businesses. The companies that we hold in the portfolios naturally have a lower level of debt. They're well-run businesses. We want to be investing in quality companies that are managing that level of debt. So that insulated the portfolios more than if we'd been in highly indebted businesses. And that's why taking a really selective approach is crucial. We may well see interest rates come down marginally, but we're not going to see them come back down to where they were before anytime soon. So making sure that you have that quality business in a portfolio is crucial.
Jen, you're up again.
I am up again. Yep, sorry, I'm too slow on the screen. Right, so this is looking slightly more to the future. Does AI, that's artificial intelligence, have any place in financial wealth management? Do we at Phoenix have any long-term plans to use AI to analyse trends or inform future investments?
No.
Wow.
No, that's too flippant.
statement.
That's too flippant.
I was going to say, yeah, absolutely.
I mean, yeah, I think AI will have a huge impact on the world. I would be very candid. I don't know exactly what that impact looks like. We have been watching with interest the evolution of things like ChatGPT and all these kind of things. We've actually played around with it because it was an easily accessible first experience of what it might look like. I know, I'll tell you, we were doing the market commentaries in January, and Jen went onto ChatGPT and just said, I wonder what this thing does. Can it write my job for me, kind of thing. Put in, write me a market commentary, and it said, I can do the fourth quarter of 2021. Is that any good? Went, not really, no. So, it's got a long way to go. There is much ethical and academic debate about where it should be allowed to go. So I have no clarity on what it will do for us, but do I think it'll change the world in which we live and the way we work? I would say yes. In the short term, I don't know. I don't know how fast this is going to become usable and practical. I don't have clarity on that. But we'd be ostriches, head in the sand type people if we didn't think this could be big.
We're starting to use it for video editing. So the first few rounds of video editing, you can get AI to do that pretty effectively. We're using it to enhance our slide decks. Again, you can just tap into this enormous wealth of data to get your slides looking from my basic first draft to a much more sophisticated, neat-looking slide deck. Again, you have the human intervention at the end. We're not completely replacing someone writing a slide deck with a computer. We're looking to partner with a company like ChatGPT, because what ChatGPT brings together is all of the information that's ever been on the internet about Q1 2021. But if you use it in a different context, you can gather all of the information that's known within your business about a specific topic. So here in the UK, I have specific knowledge about vertical farms. There might be something really fantastic that someone over in Singapore is also doing. So using it as a database consolidator, then anyone within my business can put vertical farming into the system and then pull all of this knowledge that's in everyone's brains in one place. So there's really effective and valuable uses of it. Where it's quite funny that you can see the application of it is through our graduate recruitment systems. And the answers, the free-form answers, you would not believe the percentage of people that start submitting such similar content. So we have these open questions, and then we have the ChatGPT answer, so that you can cross-reference who's actually written it and who's just taken it straight from the system. So pros and cons.
Well, if you want to talk about an organisation with issues with that, the Open University must be terrified.
Yeah.
Because they will have no idea who's written their submissions at all, and I suspect they're doing exactly the same thing. So whenever you do, bear in mind, you don't sit an exam, you're sat at home typing away, or are you? They must be checking.
You can get AI to do that, though, as well.
Yes, exactly. So you get AI to check itself.
Yeah.
And then
Our company is using AI to do client report writing as a first draft. Yeah. Means actually we can get that out much quicker to clients, and it is quite amazing. Obviously, we will proofread it before sending it out, but they literally just get it to do the first draft.
Which is exactly where we went to test it to see if it could, and at that point, that was a few months ago, it couldn't. These things change all the time. If I went on today, maybe it would go, there you go.
Yeah.
There's your first draft.
Yeah.
So, I mean, there is clearly, Phoebe's talked about social change and the importance there. This is redundancy. You can see it. Big technology invariably involves people reallocating from certain jobs to new jobs. So, we've got to be careful we don't let this run too fast, because, again, if you're given time, then you have time for society and the workplace market to evolve. So people who are removed from here, those report writers that now don't have a job, can be reallocated somewhere else. If you let it go too fast, you just get people out of work. So as with all technology, you've got to be aware of the negative impacts that it can have. But it's coming.
The regulation seems to me to be a problem too. It will always seem to be.
Yeah, with all very new technologies, there isn't any for a while, because everyone sits around and debates, well, what do we need to regulate? How do we control this? What are the parameters? And there'll be radically different views across the globe on what is and is not okay. And we're in a reasonably fractured globe at the moment. Are you going to get everyone around the table to have that conversation easily? don't know.
But the AI policy departments in these big tech companies are huge. So they are investing in people. We want to hope that they're not just investing in those people to get round the policies. But yeah, it's a real minefield.
One here, please, Amona.
We have 2030 as a deadline for electric vehicles, and yet we seem woefully unprepared at the present moment. Can you see an improvement taking place, and are there opportunities for you in that sense?
Yeah, absolutely. I hope that we stick with that target because that then really forces investment and focuses the mind and government policy. We do need a massive ramp up in government commitment and spending. But I think it will be forced by competitive advantage or competitive disadvantage. And that's really where the sustainable investment world has got extremely exciting in the last 6 months, because it's gone from it would be nice if we all invested in a green world to, Jesus, the US is putting a huge amount of money behind this. China is obviously leading the charge. The Middle East and the UAE, Saudi are throwing huge amounts of money, as is Europe. So it's really raising the bar in terms of government policy and commitment. The UK is still sort of, not announced anything in any meaningful way to date. But clearly they've got that commitment. They've also got this real pressure from a competitive advantage perspective or competitive disadvantage perspective, which I think will force the hand. Unfortunately, there are the political issues, and it will be interesting to see the dominance or the increasing prevalence of Labour, because clearly Keir Starmer, the one thing that he is being clear about is that climate's important to the Labour Party. And if you look at the topics that are tier 1 or tier 2, have tier 1 or tier 2 importance of voters here in the UK, climate is first or second. So any party needs to be sort of aware of the importance of investing in this area. And I think if we have a Labour government, they'll probably try to catch up with Europe and the US in the way that Conservatives seem to be not that bothered in doing so.
I think that's probably the message that Phoebe's been bringing across today, is this has gone from a values-driven thing to a commercial imperative. That if you're a business and you're not doing this, then you're just going to lag, and you're going to struggle.
And same with countries. If you're in a country not doing it, you're going to lag. Yeah.
I think we're lagging.
I would agree.
Yeah.
Would you say that the Americans
Sorry, can
might
we
have
bring
a
you the mic
problem
back? Sorry.
if the Republicans come into power? We know that Democrats are more green than the Republicans are, so might there be a move backwards rather than forwards?
That's why it's so remarkable that they passed it, because it's such a split House and such a split Senate. So I think it's now an apolitical topic in terms of importance. And the one thing that unites the Democrats and Republicans is real fear of the dominance of China. And so there's a lot of anti-China legislation. We've spoken about the Xinjiang region. They've created an entire bit of legislation preventing any semiconductor from being imported into the US from China, because they're so worried about the dominance of China in yet another marketplace. Now, they've spun it in a human rights way, which is semiconductors are made from polysilicon, amongst other things. A lot of that comes from the Xinjiang region, where we know there's forced labour. But the actual goal is to try to prevent China being as dominant in the marketplace of the US. So I would agree with you, if there wasn't this sort of other element to it, which is trade war, maybe you might get a rollback from the Republican Party. But I think that hopefully at this stage the Republican Party, and it seems from the votes that they are really aware that this is a much, much bigger issue than that. Now, the cynic in me thinks at least there's a reason. At least there's a reason as to why all this money is going in the green direction. And it might not be because anyone really cares about the environment in certain parts of the landscape, but the outcome is the same. And that investment in a green transition is I think it's gone too far, and there are too many layers of the conversation now.
Jenny, we got some more?
I do, yeah. I've just got a final one here, and we're returning back to AI, actually, and technology. What opportunities have the portfolios captured in technology and more innovation-driven sectors, such as artificial intelligence?
Nick, do you want to take that one?
Well, we have exposure to IT within the portfolios, focusing on sort of some of those smaller companies, perhaps those less well-known companies, you know, not the big Apples, and which we have in other portfolios, but we've sort of targeted more smaller, innovative ones. However, we've also known in the last year that IT technology company prices got very high in stock market terms. And so actually it wasn't an area that we've been chasing in recent times. Prices have come down quite a lot on technology. They do look a lot more attractive today than certainly what they did look like last year. So it's an area that we're increasingly looking towards. Although, as I said earlier, it's still hard to call IT stocks cheap today, even given how fast they grow. But nonetheless, it is an area that is increasingly looking interesting towards us.
I think from our sustainable perspective, if you're investing in a company that's thinking about a more sustainable future and solving some of these problems like water, the lack of water, climate change, inequality of access to healthcare and education, if these businesses are not laser focused on innovation, then the investment case is pretty thin. So it's not necessarily about thinking about the exposure to tech, which we all know is in everything, but it's about what's that innovation look like in farming, like I spoke to you about. What does that innovation look like in the healthcare industry? Now, at the moment, that's all about diagnostics. We're all very comfortable and aware of testing ourselves or being tested as an idea about preventing illnesses rather than letting them become problems and actually more expensive problems for our healthcare systems. Clearly, a huge wealth of innovation in the green transition space. Things like carbon capture and storage getting a lot of attention, green hydrogen. And it's not about finding startup businesses that are going to make or break. It's about finding really established companies, often that are diversifying into a new end market, using their expertise to do so. So I'll give you one example, a company called Lind, an industrial gases company that's been around for over a century. Lind is becoming a real leader in the provision of green hydrogen. So a massive lorry on a hydrogen fuel cell goes to refuel in Europe. There's about 150 fueling stations in Europe where you can fill that lorry full of green hydrogen, which for a lorry is a really good alternative to electric vehicles, which the battery runs out, we all know, far too quickly. So there is a lot of innovation. You don't have to look at tiny startup niche businesses to get access to the most exciting ideas for tomorrow.
If there's no more, I'm going to ask Ange if we are ready for... Sorry?
Great.
Yeah, okay. Lunch is ready, you'll be pleased to know. Could I ask you to fill out the feedback forms, please, as usual? We do find them very useful. And thank you for your time. And please come and join us for some food and drink.
Thank you.
Thank you. Thank you, Nick.